Welcome back. So as you know, we've talked about a number of different spaces. We've talked about the funding landscape, the capital pipeline. We've talked about determining your capital needs based on burn rate, runway, and hypothesis that we're testing. We've talked about the 9 points of how an investor thinks about approaching a deal. We've talked about how you build your investor pitch deck with focus on top-down and bottoms-up market sizing, looking at lifetime value. And we've talked about thinking about that market size in the context of an investor approaching a specific type of deal. So how an investor thinks about what moves the needle on their own fund and how we can position the bottoms up market to get to a revenue target that actually provides the scale of opportunity that's commensurate with the stage of investment that particular venture firm is looking for based on their ownership target. And now we're going to talk about how this implies your company's valuation. So how we actually think about the valuation of your company. So what are the levers that determine valuation? Basically, valuation is determined by a number of things, including sort of the technology or the intellectual property, the team, who you are, the expected value of what you're building into, the market size and how big the opportunity seems, the velocity or the traction that you're able to get based on installs, based on engagement, the macro trends of the tectonic plates within your space and how these plates are moving, and whether or not it seems like you're positioned to capitalize on a number of trends where there's willingness to pay, and to some degree the power dynamics between the interest from investors and sort of where you are in the space of raising money. So early stage venture capital really is not quote unquote finance. It's nice that we lump it in the finance bucket, but there are no discounted cash flows. There are very few financial models. But really what investors are thinking about at the earliest stages, there becomes much more heavy finance as you get later into growth equity and definitely into private equity. But when you're early in venture capital or seed capital, really VCs are looking for proxies of value. And these proxies of value are ways that they're thinking about how this company could be worth a lot of money in the future. But right now, they're not really sure. So they're thinking about things like profit, like revenue, like willingness to pay, like month-over-month growth, engagement, like monthly active users or daily active users if it's on an app, installs, barriers to entry, how you're going to keep the competition out, and if your product is truly sticky and people have trouble switching, so high switching costs, and if there's a past proof of execution on the team, and ultimately, if there's also sort of syndicate signaling around other investors showing willingness to invest in your company as well. And this last one is interesting because it's not something that most investors would admit to, but I do think it's a key part of every investment is sort of who else is looking at the deal. Can you build the momentum in the market and kind of prove that you've got the ability to really get people jazzed up about your idea, including other investors. So venture math works based on a number of inputs. Basically, the company or the entrepreneur specifies an amount they're raising. Now, this amount, if we go back to a couple lessons ago that we talked about, is based on a specific hypothesis that they want to test, something that they want to test to de-risk the business. And based on that hypothesis, based on a burn rate of who they're going to have to hire, how much they're going to have to pay them, how much this is going to cost per month, that burn rate multiplied by a number of months it's going to take in order to test the hypothesis implies an amount of money that company is going to raise. So the company says, we want to test hypothesis X, and it's going to take us this many months at this burn rate, and it's going to imply this amount of cost. Therefore, we're raising that amount of money. At the same time, the VC is thinking to themselves, well, we borrowed this money from our limited partners. We've got to make a return for our limited partners. And so we need to figure out what the ownership target is that we need to own in order to work with this company for the next few years and be able to really engage with this company, put a lot of time and effort into helping them scale the company. And what amount of equity is really going to make it worth our while. So typically, as we talked in last lesson, that's about 20% for a typical venture capital firm. So then there's just believability around that math. And we're going to walk through that right now. So let's take an example. What does this mean? So it means if we're testing a hypothesis that's going to take 18 months of runway and we have a burn rate, let's say that we need to raise $5 million. Now, if we do the math, basically our target runway we're saying is 18 to 24 months that we're going to spend working on a problem, testing a hypothesis, building a team. The target raise for our startup is $5 million. So this would be a very typical Series A investment. So probably the second institutional round of money after the seed investment. And the VC target is 20% ownership. So this is just an example. We're making assumptions here. That target could be lower or higher depending on who we're talking to and depending on some of those power dynamics that we discussed. But the implied valuation here would be that $5 million equates to 20% ownership. So $5 million divided by 0.20 implies a post-money valuation, or a valuation of $25 million after that $5 million is deposited in the startup's bank account. So let's think about this. So the implied valuation is $5 million divided by 20%. So $5 million as an investment is equivalent to 20% ownership in the company. So in other words, for the VC firm's $5 million check to equate to 20% ownership, the company has to be worth $25 million post-money valuation. Or the VC firm now owns shares equivalent to 5 divided by 25, right? Or 20% of the company. So this is sort of the way that valuation works. It's almost backwards. So the startup says, we're raising X amount of money. The venture firm says, well, we need ownership Y. And that implies a post-money valuation. So if we think about this another way, the investor is going to make a determination as to whether this makes sense to pay $5 million for 20% of the equity or 20% of the shares in the company. Or in other words, if the company is actually worth $20 million pre-money or before the investment goes in, or $25 million post-money after the $5 million is wired to their bank account. So this is really the math that's happening in the background, is the startup is saying, we need to raise $5 million in order to have 24 months of runway in the certain burn rate in order to test this hypothesis. And the venture firm is saying, well, for our model to work, we need to own 20% of that company. So if we figure that $5 million is worth 20%, is this company, can we come to a realization, or can we come to a firm belief within our partnership and as a consensus that this company is actually worth $25 million in a post-money valuation? So, we'll think about this through the proxies of value. We'll think about this from the standpoint of forward valuation, meaning can we pay forward into something, maybe the company isn't worth 25 million today, but if we truly believe it's $1 billion idea, maybe it's a good investment to invest in it now at 25 million, even though they might not have all the bells and whistles in order to be truly valued at that right now. Maybe we pay forward because we have strong believability that this is a big idea and we really believe in the team, we love the technology, and we think the market is there. So really we're testing the believability of these ideas. So as a valuation exercise, let's think about you. So what's your hypothesis? What are you testing specifically? What's the burn rate per month it's going to cost to get you there? And then how much does 18 to 24 months of runway cost? So this is going to imply for you an amount of capital that you need to raise. And now if we take that amount of capital, let's say it's $5 million, and we divide it by 20%, which is the ownership target that we've made the assumption that most venture firms will probably be thinking about, that creates an implied post-money valuation of, as we talked about in the last example, $25 million. So do that math for your own business, thinking about the hypothesis, the burn rate, and 24 months of runway and how much that would cost you. Thanks so much, and we'll reconvene in just a moment.